Hi everyone, how are you all doing? Welcome back to our financial modeling tutorial. In this episode, we'll be learning how to create a financial model from start to finish. There are two important things to remember when making a financial model. There are two key stages to keep in mind. First, we need to construct the essential building blocks. Then, we connect those blocks into a unified structure. For the first step, which is creating the key basic elements that make up the financial model. There are several important basic elements in building a financial model. These include revenue and cost projections, investment and funding sources, fixed and intangible assets, loans and interest expenses, working capital, and finally, financial statement forecasts, the income statement, cash flow statement, and balance sheet. Regarding the first and second points, usually the calculation models are different or unique for each type of business. Meanwhile, from the third to the sixth points, generally they are more or less the same, with only slight differences depending on the type of business. So, it's important to understand the business context before building a financial model. Even though all projections eventually lead to the same three reports: income statement, cash flow, and balance sheet. The second step is connecting each component we've created into the financial model calculation. Here's a rough flowchart of how each part is connected to form the financial model. Feel free to take a screenshot or photo for reference. For the details, you can check back on episode 1. Now let's learn together how to create a financial model from start to finish. The example we'll use is a cafe business. You can download the Excel file used in this video from the link in the description. Okay, now let's open the Excel file. At the beginning, there's the revenue projection. So, let's just take a look at the total revenue, which comes from several sources like coffee drinks, snacks, and other income. Similarly, for direct costs, there are also several components like coffee costs, other ingredients, snacks, and other expenses, including overhead. Next, we move to administrative expenses, things like office supplies, marketing, and salaries for staff and management. Next, let's move on to the investment section. I've marked tangible and intangible assets with different colors. This helps us separate depreciation from amortization. That's because later the calculations and grouping will be different. One goes into the depreciation group and the other into the amortization group. In the balance sheet, they'll also be recorded under different categories. So, it's important for us to separate these two types of investment groups from the start. In calculating depreciation costs, it includes a schedule for depreciating fixed assets, excluding the land value. The capital expenditure values originally come from fixed asset investment groups according to the color coding I marked. I also added a section for asset sales in case an asset is sold midway, which would reduce the asset value on the balance sheet. But here, I left the value blank, meaning the asset is held until it has no residual value. Then, there's a depreciation cost calculation schedule over 5 years using the straight line method. You can also see the asset position from the beginning to the end of the period in order. Over 5 years, the asset value will be fully depleted to zero with no residual value. Even though physically the asset might still be usable, from an accounting perspective, it has no value at all. Next, when calculating amortization costs, it includes the amortization schedule for intangible asset groups. This value originally comes from the intangible fixed asset investment group, as marked in the color I highlighted. Here, there's an amortization schedule for intangible assets amortized over 3 years using the straight line method. You can also see the asset position from the beginning to the end of the period in order. You can see that over 3 years, the asset value will be completely gone. Next, we schedule the loan repayment. Quick note, there was a typo in the original file, the currency should be in dollars. The downloadable file has been corrected. Here, the loan amount refers to the top part in the funding source under investment details, which is around $5,500 or 70% of the total investment. The loan term is 5 years. You can see here there's a schedule for principal repayment over 5 years using the PPMT formula. Additionally, I also use the IS error formula to avoid calculation errors if the loan term changes. Otherwise, any changes in the financial model assumptions would require us to recalculate manually, which is really a hassle. Then here we have the interest cost calculation. I calculated it in a simple way to make it easy to understand, which is interest rate times remaining principal. You guys can also use the IPMT formula. The result will still be the same. I use the PPMT formula when calculating the principal repayment installments so that the total interest and principal paid to the lender is the same throughout the year until the term ends. This definitely makes it easier for the lender to keep track of principal and interest payments. Next is the calculation of working capital. The basic assumption is how many days, on average, this business needs working capital out of the total 365 operational days in a year. For example, if receivables are 1 day, it means that out of the total sales for the year, about 1 day's worth of sales is unpaid. The same goes for accounts payable. In this example, payables to suppliers are roughly equivalent to 7 days of the total direct costs for the year. The difference here is that receivables are based on total yearly revenue, while other items like inventory and accounts payable are based on total direct costs for the year. For simplification, here we consider it against the total direct costs for the year. In practice, inventory value, for instance, might depend on certain cost components rather than the entire direct costs. The last line shows the amount of increase or decrease in working capital. This value is later used to calculate the company's cash needs in the cash flow statement. If there's an increase in working capital, it means we need more money to cover cash requirements for working capital, which is marked as a negative number. On the other hand, a decrease in working capital means the cash needed for working capital goes down, so the cash is freed up, marked as a positive number. For a more detailed explanation about working capital, you can check out my video on a tutorial for creating a simple financial projection. Now let's move on to the income statement. Revenue is pulled directly from the total revenue section above, which I've marked in green for easy reference. The same goes for direct costs, which are taken from the total direct cost section. Then we calculate gross profit, which is simply revenue minus direct costs. Next, we include administrative expenses, also taken from the total admin cost section above. Then we add depreciation expenses, which include amortization and depreciation costs. We get these numbers from the depreciation and amortization schedule calculated above. Following that is interest expense, which comes from the loan repayment and interest schedule. After that, there's the income tax burden. Here, I set the percentage at 22%, but you can adjust it as needed. I used an if function here, which means if the business is running at a loss or the value is negative, less than 0, then there's no tax. But if it's greater than 0, meaning the business is making a profit, then tax applies. Without the if function, tax might show as a positive expense even when there's no profit, which would distort the model. That's why we add extra functions as a precaution. Just like with IS error in our previous example, this logic helps us avoid manual recalculations when assumptions change. Next, let's move on to the cash flow statement. Here, we're calculating it using the indirect method. If you want to know what direct and indirect cash flow statements are, you can check out my video on a tutorial for making a simple financial projection. At the top, there's net profit. We just take the value from the income statement above at the very bottom. Then there's depreciation expense, which we also take from the income statement. Next is the change in working capital, which we take from the increase or decrease in working capital calculated in the section above. In the first year, since the business hasn't started operating yet, cash flow from operations is 0. However, cash flow from investing and financing already shows activity due to capital expenditures and funding inflows. Under investing activities, we record cash outflows for capital expenditures and intangible assets, with values taken from the investment section above. Next up is cash flow from financing. There's cash coming in from loans in the first year, and then there's a schedule of principal repayments over the following years during the 5-year loan period. All these amounts come from the principal and interest payment schedule above. Then, there's equity or capital contributed by investors for the investment. It amounts to 30% of the total investment, based on the funding source calculations above. Below, there's the calculation of dividends or profit sharing. This value is calculated based on the dividend percentage time net profit, here assumed to be 10%. The value is negative because dividends are cash outflows paid to shareholders. Finally, we calculate net cash flow, which is the sum of cash flows from operations, investing, and financing. The last line shows the ending cash balance, which will be recorded in the balance sheet. You'll notice that cash accumulates year by year as net cash flow adds up. Now, let's move on to the balance sheet. Cash is taken from the ending cash balance in the cash flow statement. Working capital items like accounts receivable and inventory are sourced from the working capital section above. The same applies to current liabilities like accounts payable and accrued expenses. Next, we have fixed assets, both tangibles and intangibles. Their value is taken from the asset value at year-end after subtracting depreciation and amortization. Then comes the debt position. Loan balances are taken from the loan schedule, showing the remaining principal after repayments. Current and non-current liabilities are then added up to get total liabilities. After that, there's capital contribution. The value comes from the total equity deposits recorded in the cash flow statement. This value can accumulate in the following years if there are additional equity contributions. Next, we have retained earnings. Retained earnings are the company's net profits that are kept for business development. Retained earnings grow with profits and shrink with losses. The calculation is the previous year's retained earnings plus current net income after deducting dividends paid to the business owners. The sum of liabilities and equity must equal the total assets. That's why it's called a balance sheet. It has to be balanced. If there's a mismatch, the model is incorrect and need fixing. So, it's a good habit to create a line at the bottom for the difference to check if the total assets match the sum of liabilities and equity without any discrepancy. At the end, there are financial ratios. I wouldn't show all of them, just a few commonly used calculations. On the first line, there's revenue growth. This value is calculated from the percentage increase in revenue this year compared to last year. It's useful to see whether our business is growing, staying steady, or actually declining year by year. On the next line, there's the gross profit percentage calculation, which is the gross profit divided by revenue. This helps to know if the revenue earned is enough to cover direct costs before paying for other expenses. This calculation is like the first checkpoint to see if the business is viable or not. If it's already losing money right here, then what's the point of continuing the business? Next up is the EBITDA profit percentage. Investors often use this to see how profitable a business is after covering operational costs. EBITDA is also commonly used as a basis for valuing a company. Even if a company is losing money, if its EBITDA is positive, it can sometimes have a very high valuation, especially for startups with strong growth potential. After that, of course, there's the net profit percentage, which helps you see what percentage of profit we get compared to the revenue. Then there's asset turnover. This shows how effectively a company's assets are being used to generate revenue. If a company has big assets but low revenue, it means a lot of assets are just sitting around and not being used efficiently. Next, there's the current ratio and quick ratio. Both are used to see how well current assets can cover current liabilities. If the value is low or below zero, it means the company might struggle to meet its current obligations and could go bankrupt at any time. The current ratio looks at all current assets, while the quick ratio only counts assets that can quickly be turned into cash, like cash itself and accounts receivable. The next part is the solvency ratio. This ratio is often used by lenders to check a company's ability to pay back its debts. The first one is the income before interest to interest expenses ratio, which shows how well business income can cover interest expenses. Then there's the debt-to-equity ratio, which measures how much borrowed money is used compared to the company's own capital for investment. Whether the loan amount to equity is reasonable depends on the type of business. Next up is the net gearing ratio. This basically looks at the company's ability to use loans to drive the business after accounting for cash on hand. If the value is negative, it means the loans aren't really helping the business operations at the end of the year, since most of the working capital and operational costs are already covered by the company's own cash. In this situation, it's usually better to pay off the loans quickly using the available cash. Lastly, there's the return on assets and equity ratios. First up is return on assets, ROA. This ratio measures how effectively a company's assets generate net profit. It's calculated by dividing net profit by the average total assets. We use the average because the total assets can go up and down during the period. The next ratio is the return on equity, ROE. This ratio measures how effectively a company's equity generates net profit. It's calculated by dividing net income by the average total equity. From the calculation in this example, you can see that the percentage keeps dropping year by year. This is because the company is becoming less and less effective in managing its assets and equity. More cash is piling up without being used for business development, making the company less efficient. Here, we're just assuming the company only has one café as a business location. In real life, businesses with excess cash often expand. They will likely open more branches. They might even take additional loans from the bank to accelerate growth. So year by year, the company's growth will remain stable, and the return on assets and equity won't drop too much. This means the use of the company's assets and equity are used optimally. And that wraps up our full walkthrough of the financial model. Thanks for watching. I hope this was clear and helpful. Keep learning, keep building. See you next time. Cheers.